So let's take a look at how the rules of debit and credit work, right? So we know the word debit balances, expenses, assets, dividends, right? So that's where we need to go through when we look at an account name. We're going to say what the classification is, and then based on the classification, what's the normal balance? What has it been assigned, a debit balance or a credit balance, right? Because it's just really important to get comfortable with what the normal balance is for these accounts. So you get to the point where it's just second nature. You don't even have to think about it. Okay. So the accounts that are stockholders' equity is the common stock, the retained earnings, okay, and then the things that change retained earnings, revenue, expenses, and dividends. Those are all considered when you do your My Accounting Lab. Those will be part of equity. But because we have kind of different balances, right? The dividends and expenses have a debit balance, the revenue, the retained earnings, the common stock have a credit. We're going to look at them in their own category. Okay, so to start off, cash, we know cash is an asset. Asset has been assigned a normal balance of debit. Wages expense. So the classification, it's technically equity, but I like to look at it in its own classification as an expense. And the normal balance of an expense is debit. Accounts receivable. Okay, again, that's an asset. Assets have a normal balance of debit. Common stock. Okay, so this is stockholders' equity. The normal balance is going to be credit. Service revenue. Okay, and your My Accounting Lab exercise, it's going to want you to say that it's an equity account, but I like to look at it in its own classification of revenue because it's kind of got its own balance. Revenue has a credit balance. Prepaid rent. Prepaid rent is an asset, normal balance debit. Accounts payable. Whenever we see the word payable, we know we're dealing with a liability. Liabilities have a normal balance of credit. Income tax expense, right? So expense affects equity. In My Accounting Lab exercise, you'll choose equity. I like to look at it in its own classification, and expenses have been assigned a normal balance of debit. Income tax payable. Again, the payable tells you it's a liability. Liabilities have been assigned a normal balance of credit. Land is an asset with a debit balance. Supplies expense, again, it's technically equity. We're going to consider it an expense. Expenses have a normal balance of debit. Prepaid insurance. Again, your prepaids are an asset. Normal balance for assets is debit. Utilities expense, technically it's equity. I like to think of it on its own as an expense. Normal balance debit. Dividends. Okay, so this is going to be listed. It even has an account number of a 3 because this is considered equity. But again, it kind of breaks the rules. So I look at it on its own classification. I say dividends. That's the other D in the word dead. So that's a debit balance. Unearned fees. This is the new liability account we're dealing with, right? When a customer pays in advance for work you're going to do later. We can't record revenue because we haven't done the work yet. We owe services to a customer. It's a liability. Liabilities have a normal balance of credit. Equipment is an asset with a debit balance. Notes receivable. Okay, I don't know that we've talked about this yet, but you see the word receivable. It goes similar to an account receivable. An account receivable is when somebody owes you on account, right? Because you billed them for work you did. A note receivable is when somebody owes you on a note. So they've signed a note that they're going to pay you back with interest. So this is an asset. Normal balance is debit. Just like I said with payable, that's always a liability. Receivables are always an asset. Supplies are an asset with a debit balance. Okay, so it's really important to know the normal balance of accounts. So then we know how they increase because they increase in the same direction as the normal balance. They decrease the opposite of the normal balance. So now we're kind of taking a halfway step. We're going to use T accounts to record transactions. So it's a halfway step to the actual formal process. So we start off the same way as when we were putting in the worksheet. When we see a transaction, decide which accounts are involved, and then do the accounts increase or decrease. But then we're going to translate the plus or the minus into a debit or a credit using our rules. Okay. So let's take a look at an example of how some of these transactions work, putting them in T's. All right, so here's our first transaction. The owner is Ella Clooney, and she's opening Ceramics Repair Services. She's investing $4,300 in cash and $1,600 in equipment. That's her investment into the business, and she's getting shares of stock. So we are Ceramic Repair Services. We are getting the cash, we're getting the equipment, we're giving the shares of stock. So this one, we're going to have 3 accounts. Cash is going up, we're receiving cash. Equipment's going up because we're receiving equipment. And common stock will also go up because now there's going to be shares of stock out there. So that's going up. So the cash is going up by $4,300. Cash is an asset. The normal balance is debit. So if it's going up because we're receiving it, we're going to put the $4,300 on the debit side of the T. Equipment is also going to be a debit because it's also increasing and it's an asset. So $1,600 is the repair equipment. Common stock is going up because now there's going to be shares of stock out there. Common stock has a normal balance of credit, so we are going to put $5,900 on the credit side of the T. So we can see we had debits, and we abbreviate debit as DR. It stands for debit record. CR stands for credit record. So our debits are the $4,300 plus the $1,600. So we have debits of $5,900 on the debit side of the T, and then on the credit side of the T, we have $5,900 put in the common stock T. So we can see that debits equal credits. Okay. For every transaction, this needs to be true. So just like our accounting equation always has to balance, debits always have to equal credits. So that was our first transaction. Transaction B. We paid $400 for the current month's rent. So the accounts that are involved, cash, because we're paying, and then rent expense, because that's what we're doing. We're paying our rent. So cash is going down because we're paying it. Cash is an asset, normal balance of debit. So if cash is going down, we're going to put it on the opposite side of the T of the normal balance. Normal balance is debit, so cash goes down with the credit. We put $400 on the credit side of the cash T. Expenses really only go up in ordinary business. Expenses have a debit balance. It's the E in the word DEAD, D-E-A-D. The E is expenses. So we'll always be putting amounts on the debit side of the expense T. So we've got a debit to rent expense, a credit to cash. Purchase supplies on credit, $500. So we're getting supplies. Supplies is an asset. Normal balance of debit. Supplies are going up, so we put it on the side of the account with the normal balance. So we're going to put $500 on the debit side of the supplies T. We bought it on credit. That means we owe for it, right? On credit and on account mean the same thing. That means you're going to be paying later. So that means we have an accounts payable. Accounts payable is a liability, normal balance of credit. And so our accounts payable is going to go up. Our debts go up. We got the supplies and now we have a debt. So that's going to go on the credit side of the T. So again, we've posted a debit and a credit. You have to change at least 2 things. Next, we purchased equipment by issuing a $2,000 note. Okay. So we're getting equipment. Equipment is going up. Equipment is an asset with a debit balance, so it goes up with a debit. And we signed a note saying we owe for it, so that's our notes payable. Notes payable is a liability with a credit balance, so when our note payable debt goes up, it goes up with a credit. We paid wages to an assistant. So we see the word paid. We know cash is going down when you pay for something. Cash is an asset with a normal balance of debit, so it goes down. We put it on the opposite, the credit side of the T. And we're paying wages, so that's a wages expense. And so expenses only go up. The normal balance of expenses is debit. So $450 goes on the debit side of the wages expense T. We've performed repair services on account. So if we performed services, we know we have earned revenue. Service revenue has a normal balance of credit, and service revenue in ordinary transactions only goes up. So we're going to be putting it on the credit side of the T. That's the normal balance for revenue. And so we did the work. We're billing them for it. That's what on account means. So that means our customer owes us. That's account receivable. Account receivable is going up. Our customers owe us more because we've done work and they've got to pay us later for it. Accounts receivable is an asset with a debit balance. So it goes up by putting the amount on the debit side of the T. Transaction G. We paid $200 of the amount for when we purchased on credit in C. We bought the supplies on credit, and now we're going to pay our vendor $200. So cash is going down. Cash is an asset with a debit balance, so it goes down by putting it on the credit side of the T. And then our accounts payable is also going to go down. We're sending in $200 towards what we owe that vendor when we bought the supplies on credit. Accounts payable is a liability with a credit balance, so it goes down by putting an amount on the debit side of the T. Paid a dividend, $120. You see the word paid, cash is going down. Cash goes down with a credit since its normal balance is debit. Dividends, that's the other D in DED, D-E-A-D, debit balances, expenses, assets, and dividends. Dividends, for the most part, only go up. We're only going to put amounts on the debit side of the T. That's the normal balance. That's how it goes up. And then receive the electric bill, $215, which will be paid next month. And so we got our electric bill. We've incurred expenses because we've used up electricity. So we've incurred the expense. Expenses, we said we only put amounts on the debit side of the T because that's their normal balance and they only go up. But we're not paying it. It's not going to be cash. We owe ComEd for our utilities. So our accounts payable is going to go up. Accounts payable is a liability, normal balance credit, so it goes up on the credit side of the T. After we have recorded all of the transactions in the T accounts for the month, we can find the balance. And you find the balance by adding up the debit side of the T and the credit side of the T. All right. And then we subtract, and the balance goes on the side that's higher. So when we subtract the total of the debit column and the total of the credit column, we see cash has a balance of $3,130. Now you usually don't show the totals, you just would show the balance. So when you're in my accounting lab, you're going to have to kind of use some scratch paper to get the totals, right? Everything else, it only has one thing, that's the balance. My accounting lab does make you enter the balance at the bottom of the T. You'll have to choose the word balance, and then you'll have to bring down the 500. Equipment, there's only two things, but we add those together. Equipment has a balance of $3,600. Accounts payable We also have to total the debit side, total the credit